Now, item number 6 is the current service level budget and sources of revenue update, which will be presented to us by the Finance Department, Justin Coles and Jane DeSenza. And feel free. Did you all bring a dinner with you?
Good evening, President Brandt and Commissioners. I'm Jane DeSenza, the Budget Director here at the City with Finance and Property Services. And I'm joined today by Budget Manager Justin Coles, who will be up here in a few minutes to discuss the 2026 current service level budget calculations. So these are the estimated revenues and expenses for the following year. Were we to take no action to increase or decrease our expectations for the following supplemental year. So differently than in prior years, the current service level is not really the starting point for this year's budget decision making. It's really more serving as a reference point. So in deference to the property tax projections that we're going to be discussing throughout, our budget process this year did not invite new spending proposals from departments, and so instead we're focused more on constraining growth. Nevertheless, this is an important marker, reference point for all of you and for the public, and is also required by our financial policies and our charter. So the information that we'll get into in these slides is the result of many months of work by our team as well as other partners in the enterprise. Some of us are here from the budget division, but not everyone, so I'd just like to note that this presentation represents their work and their service to the people of Minneapolis, so we're very lucky to have such a strong team. This is a technical presentation that's focused on future revenues and expenses, and you can expect to hear more programmatic information through the budget committee process in the fall. And you will also see some references to historical actuals in these slides, again included as a reference, but we'll be focused more on next year's projections. So our agenda for today is to review that budget framework, including the estimated costs of those existing ongoing commitments. We'll compare throughout to our 2025 adopted budget. We'll have some discussion of both property taxes and non-property tax revenues with a focus on the general fund. We'll tie things out with the general fund outlook, so how our expenses and revenues stacking up, and then we'll go to our timeline and next steps for the fall. So some key takeaways. With many decision points to come, this being just one stop on the process to a balanced budget, we are seeing, when looking both at all funds and refining down to the general fund, that expenses are outpacing revenues. So when looking at all funds, you can see that expenses are projected to increase at about 1.1%, while revenues are at about 0.17%. This is, with several funds yet to be finalized, so we'll be continuing, as we always do, to refine the capital enterprise grants and downtown assets funds over the summer. When we look at the general fund, you can see that expenses are increasing by 3.89%, while revenues are coming in closer to 3.64%. So these are modest gaps between revenues and expenses, which is fairly typical at this time of year. But we are seeing, increasing personnel costs, while revenue growth is much more modest. Just to note, last year at this time we had a much more dramatic gap between expenses and revenues than we're seeing this year. So this is, in many respects, a much more stable position. So as we talk about the general fund, we wanted to give you a visual of how that relates to the other funds. So when looking at our 2026 current service level, the general fund is about 63% as it relates to other special revenue funds, so the grants, debt service, and capital projects. All of these funds have descriptions in the budget book, and we're happy to help you find those if you have any further clarifications that you're seeking on those. This image is meant to illustrate the distribution of property tax versus non-property tax revenues that are coming in to support the general fund. So the story that it's telling and is consistent when we looked at prior years is that property taxes are supporting to an increasing degree, the revenues. The overall share of property tax is shown on the bottom in blue versus the non-property tax revenues, so things like fines and fees, licenses. In the past, those non-property tax revenues were picking up more of the proportionally, and we're seeing that property taxes are slowly but surely ticking up in their importance. Okay. And so on this slide, just to remind us all where we ended the year with the 2025-2026 adopted budget, we've put a box around the levy numbers for those 2 years. And the percentage, as a reminder, is the percent change in the dollars that we're collecting from one year to the next. And so due to some cuts for the 25 levy, that percentage dropped a couple points down to 6.8% for 2025. Those one-time reductions, though, come back in 2026, and so we see 10.8% of the levy was the starting point for 2026. So double-digit levies are certainly not the norm, and so that's something we were mindful of starting the year. And since then, we've reforecasted revenue as well as expenses and our internal service charges. And so the new sort of preliminary number, starting point for decision-making, is that 11.2% levy for 2026. Primarily, this is due to increased costs.
Excuse me,
Sure.
Director, you lost me there.
Yep.
Where's the 11?
The 11.2% is in the red box on the screen, and so that's the 2026 estimated property tax levy increase. Okay. So that's the percent change from the $25 amount.
My version says 10.8. Is that just an earlier version?
I think that's the prior. If you switch to the next slide, there.
Got it.
Yeah,
Got it.
I'm trying to illustrate the flow over time.
Thank you.
But thank you for clarifying that. So that's just an illustration of what happens when we reforecast those expenses and we capture, any new, whether those were new union agreements or reclassifications of positions, job studies, that sort of a thing. Those are all captured there. Did want to note that we plan for normal inflation going forward. We do not plan for any new spending to come into those years following 2027 and beyond. We also assume that federal funding continues. So that is an important caveat to note for future decisions. In this visual, all other levies besides the general fund are shown as consistent with what was adopted in December. So I think some things to note, the permanent improvement levy has a little bit more congestion in 26 and 27, and then sort of stabilizes in 28 and beyond. The park board levy was a subject of discussion last year, and so in sort of the inverse scenario with the overall city levy, park board's levy had a one-time increase in 2025, which has sort of shrunk the percent change between 25 and 26. And also just to note that we have a number of pension levies that are part of the city's commitments. We continue to analyze those annually with the controller team help to make sure that we're levying enough. We'll revisit those if we're able to make or need to make any changes there. We'll recommend that for August as well. Many of those will expire in 2031. So next year at this time, you'll see a year without those pension levies in our long-range financial plan. And then finally, just to reiterate, I think we've heard from the mayor and the council, and certainly President Brandt, that this sort of high property tax levy is not desirable and not something that we want for the people of Minneapolis. And so we're continuing to work to find ways to bring that number down. And then the final slide for me before Budget Manager Coles comes up here is just a note on the capital improvement program. So this shows what was adopted in 25 for the 6-year plan. So no changes here, but you can see that the planned amount for 2026 sort of functions as the current service level for capital. So that's $267.8 million. We are well on our way with the Capital Long Range Improvement Committee's process this year. They're the resident body that reviews capital budget requests from the Park Board, from the city, and from the MBC. And it is a really robust job that they do. They have 2 full days of presentations on all those capital budget requests and ask some really tough questions, offer critiques, and positive feedback where it's warranted. And so we're happy to support that process. This year, they're considering 136 different capital budget requests, which over the 6 years totals about $1.95 billion. And with that, I'll invite Justin Coles.
I wonder if would this be an appropriate point to stop and ask if there are questions for what we've heard already? Commissioner Benny.
Yeah, thank you. Thank you for the presentation. And I actually went back and looked at last year's because I was preparing for this meeting, and I was happy to get this presentation today. In the future, if we could get it a little bit earlier, because I do have a day job.
Sure.
Don't tell my employer I looked at this presentation during my day job hours today. But so one thing I want to just point out, and I'm glad you said that, Director DeSenza, if you could go back a couple of slides, the 25-year, the previous one, the adopted. So if you look up there on the Park Board line item for 26, do you see we have projected now for this year from the city and an adopted budget of 1.37%. Mm-hmm. Last year when we were figuring out how to increase the amount for the Park Board, that number was 2.6%. So even though we agreed to get like 0.2% more for the Park Board for this calendar year, I don't think that we knew that was going to diminish the amount we got in 26. But it looks like, the Park Board didn't have a chance to weigh in on that 26 number, and it was apparently adopted by the City Council, and I'm sure no one was looking at that line item. So I don't really like that. I don't think that's great that happened to the Park Board. And then if you could go to the next slide. And also, I would say for 26, we were projecting that we need something like 6%, and we brought that up last year, but whatever. But this slide's kind of interesting. So I think there's a misnomer here, and I can't speak to the line items really below the Park Board per se. There are other entities in there, like Housing Authority and so on, but this is current service levels. So if you'll note from this previous slide, the adopted budget for the first line item, general fund, it was in the 13%. In order to maintain service levels, that's what this means, right? The city's line item would have to go to 14%, but the Park Board's still at 1.37%. And actually, we've done an analysis to say, actually, for the Park Board to maintain service levels, rec center hours, people that work with youth, mowing the grass, ice skating rinks, the list goes on. Mm-hmm. Our number would actually be, based on our current projections, 7.7%. And so this is not actually a current service level. In the red box, that's a combined average, a combined total of the levy across all of the items in that. So I think it's just really important for my colleagues up here to understand the Park Board's in trouble for next year, and I will be talking to all of you about that. But this represents actually layoffs and cuts to the Park Board. So, okay, thank you.
All right, are there additional questions? All right, I have a few, my traditional few. I read through the document today, and having been the messenger, I had to remind myself, don't shoot the messenger when they bring bad news. First, regarding the general fund expenses, one of our hefty expenses in the recent past was the new police contract, which made a conscious effort to make Minneapolis more competitive so that we could rebuild the force in response to requests from the citizens of Minneapolis. And then, of course, we have the normal regular increase from year to year for police and other city employees. Are there any tales from the extraordinary bump that don't phase in until 2026 for police, or is it just their normal contractual increase? Did all of the big bump come for 2025?
President Brandt, I believe it was all in effect prior. I think last year was a big year for contract settling, so we had police, fire, and labor's contract, I believe, were some of the big ticket items, and so certainly those contracts are playing a role.
Okay. And then the property tax levy burden chart that shows the increasing reliance on the property tax. Is that, I assume from the numbers that that's a general fund chart? Okay, thank you. So what this is showing is the property taxpayers of the city are bearing an increasing share of the burden of the general fund. And of course, within that, we also know that because of the downtown slump, people who live in homes that they own, as well as some of those who are living as tenants in apartments, are bearing an increasing share to offset the loss of downtown value. Okay, and I guess I'm just talking out loud about that, but it's notable. And I think that's all I had. Thank you. So,
Okay.
Justin,
All right.
if you want to proceed, thank you.
Proceed.
I'm sorry, we have one question.
Yeah, just thank you, Mr. President. I apologize, Justin. I'm really sorry. Just something that caught my attention was Commissioner Benet's comments regarding the adopted 5-year financial direction and the share of resources for the park board. So just went back and pulled up, and it took me by surprise. I have no memory of us ever lowering. No, I'm serious. I have no memory of us ever voting to lower the amount of share that you received in 2026. I'm not asking you to tell me that I didn't do something wrong here. I know I didn't. But I think the distinction here, just looking at the recommended budget when it came out, which you're correct, the percentage was 2.6, and then the 2026 budget as it was adopted, the percentages are different. The dollar value is the exact same. So I just don't think it's fair to say that the city, anyone here, mayor, council, staff, somehow has shortchanged the park board. You're getting the same exact dollar value. The numbers look a little different. Thank you. Was that what you were going to say, Director?
Through the president, yes, thank you. I mean, I think the percent change, we do often get caught up on that percentage, but it is the overall dollar amount. And certainly, I know we're having conversations with Park Board ongoing, and we'll have more full conversations about the levy expectations soon. So I look forward to that and anticipate, we'll have a full discussion of that in August and September as well.
If I could piggyback, I had a chance to do a little calculation while you were answering that question. And notice under the capital improvement plan investments, I'm just looking at the bottom lines here. We have a council-adopted capital improvement plan of $279 million in 2025. On one in 2026, it's planned of almost 267, so roughly the same. But then if you take the 4 out years after that, they average $252 million per year, which sounds like a cutting back on capital improvements, and I'm wondering if the council members would care to comment on whether that's a conscious decision to short in capital improvements because of other demands on the budget, or
I'm happy to address that. If you...
Very good. Go ahead.
President Brandt, that's a good flag. I think there's often a fine line of, budget works closely with our banking, investment, and debt team who were here earlier to develop what we think are responsible targets for levy-funded debt in particular. That's the item that is usually the topic of discussion. And we do often want to preserve some room in the out years so that future policymakers can, so that we're not fully exhausting our debt capacity. 5 years in advance. And so we did have a number of projects in 25, 26, and 27 that were time sensitive, in part due to the settlement agreement, that we had to really bump up the amount that we were spending on with levy funded debt in those first few years. We revisit that strategy annually, and so we are doing our best to maximize responsibly our debt capacity so that we can get those core services done for the city.
Could you just give me, so I can understand better, if you recall off the top of your head, some of the time-sensitive improvements that you had to do to live up to commitments, basically?
Yes, and this was a point of diversion between the mayor and council budget and the CLIC report last year. There are a number of settlement agreement requirements, like refurbishing police precincts that MDHR, the Minnesota Department of Human Rights, has committed us to doing. There are, a new 4th precinct building, a training facility. Those are things that our monitor has said we need to do, and so we had to find space for them in the budget.
Okay, thank you very much. I appreciate your making that more concrete. I was one of those who in years past placed a low priority on replacing a relatively new building at the 4th precinct, but I'm not on the council, so I don't make those decisions. Thank you for answering, and Justin, if you want to proceed.
Thank you. Good afternoon, President Brandt and Commissioners. My name is Justin Coles, Budget Manager. So we'll now transition into the details of the current service level. We'll talk about underlying methodology and the component parts of the CSL. The objective here is to provide you with sufficient contextual information to understand trends that we're seeing in both revenues and expenditures. Throughout the presentation, you'll see references to our financial policies. We provide these so that you can dig in further as needed. As a reminder, those policies are voted on by the council and informed by industry best practices and city and state ordinances. So moving right in. So the CSL presentation and underlying data does not bind this board or the city council to any action regarding the budget, but it explains where the budget currently sits to inform the setting of the maximum tax levy later this year. The following information I will share about what the CSL is derived from the Center of Budget and Policy Priorities. The CSL services multi-purposes. Primarily, it indicates what the city would have to spend to maintain programs at current levels with current revenue estimates and known expenditure growth in the absence of any policy changes. It reflects the impact of factors that cause year-to-year variations in service costs, such as changing wage levels, economic and demographic shifts, as well as financial impacts of policy decisions. The CSL is essential for transparency and accountability because it lets the public and elected officials see what the budget really costs. It's also a budget methodology used by states and municipalities around the country. It provides a baseline projection and tells how much it will cost the city to deliver the same services and goods in the following year. It's also important to note what it is not. The CSL is not well suited for retroactive analyses into previous year spending. Rather, it's a tool to inform current and future year decision making. In summary, it's used for calculating the fiscal impact of future policy changes. Without having this baseline, it's hard to see the true effect of those changes. The figures we will present today are a snapshot in time, but we find that they're crucial for decision-making around the levy. As we've discussed, the city uses a current service level method of budgeting, as defined by our financial policies. In those policies, it states that any ongoing service level commitments from a prior year constitute the starting point for the next year. Finance and Property Services, in conjunction with other internal service providing departments, work annually to determine the costs for the continuation of our services. The financial policy section goes on to state that any requests for new spending are received and weighed against all other requests via the unified budget process. While this is one of many budget methodologies, it effectively limits growth within discretionary budget expenditures, putting that decision-making authority in the mayor and the council. There are 3 expense components that make up the current service level budget in addition to revenues. Those 3 include personnel costs, which includes all of the wage and fringe expenses for enterprise staff. Personnel is inflated year over year to account for planned step increases, COLAs, and labor agreement settlements. Moving on, base expenses are all other non-personnel expenses, and under our financial policies, these are held flat year over year. Finally, internal service charges are calculated from internal service departments who provide goods and services to customer departments within the city. These account for the cost of a variety of services, including fleet, rent, liability insurance, and others. Internal service charges are adjusted year over year based on anticipated costs of these overhead goods and services. So starting at the left side of this slide, we see a graphic of the 25 adopted budget components. We begin 2026 CSL development using 2025 adopted budget data from these four components. Then one-time expenditures are removed from the 2025 adopted budget, so only ongoing expenditures are included in 2026. Personnel expenses go through a similar annual review, and this review is pertinent as these expenses are a significant portion of the total city operating budget. Additionally, Budget and HR have been working in recent years to both improve the accuracy of this data on existing staffing levels and compensation, as well as make sound projections for future growth. Next is the internal service fund allocation process. So during this process, provider departments estimate their expenses for providing goods and services to their customers. Then they allocate out these costs according to predetermined allocation models. Lastly, customer departments review those charges for inclusion in the CSL. We also forecast 2026 revenues. Revenue forecasts are based on collaboration between departments and budget in which impacts on revenue streams are assessed. These impacts include generally how sensitive or stable the revenue stream is, assessing if there are trends in growth or decline, are there any new revenue sources, and also looking at internal and external drivers to determine the next 5-year outlook. Each of these processes has now been completed, and we will provide comparative detail of those inputs. So over the next few slides, we'll be diving into a snapshot of the current service level expense budget for 26. While this is just one side of the equation, it's prudent to understand the current cost of the 2025 budget. Most of this slide is focused on the general fund, as that is where a majority of our programs are budgeted. It's heavily funded by property taxes, and it's where strategic decisions are made to get us to an adopted budget in December. It is important to note here that this is the cost of last year's budget today, but does not include any new spending or prioritization of programs. Across all city funds, the budget team worked to identify and remove $12 million of one-time or expiring programs on the road to building the CSL. This is inclusive of one-time funding as well as other components of the budget that are due to expire in the current year. That removal was in line with the adopted plan, so can really be seen more as a technical necessity towards creating the CSL rather than additional savings to balancing. Collectively, salary, other pays, and fringe costs initially increased $30 million based on the 2025 budget, and internal service charges by $6 million. This $30 million was then brought down to the $23.7 that you see on the screen due to modifications in how the city budgets for vacant positions, as well as blended assumption based on historical healthcare elections. Those savings are primarily reflected within the salary and fringe cost categories. While policy allows for cost escalation within workforce costs and internal service charges, the discretionary base does not receive the same treatment. The base in most cases is held flat year to year to ensure that the executive and legislative body receive those requests to increase a budget and can equitably consider that amongst all other requests. This portion of the budget includes things like training, contracts, and operating supplies. If a department wants to increase their base, whether it be to cover existing programs or to put forth new, they must submit a new budget proposal to do so, and that is reviewed alongside all other proposals. This decision authority is called out in Financial Policy 1.5.1. So diving a bit deeper into personnel costs within the general fund, with over 4,000 FTEs budgeted for the city, personnel is a significant portion of our costs. We work closely with our partners in HR and each department to complete our annual review of personnel expenses in accordance with our financial policies, finalizing budgeted FTE counts and salary and fringe for each position to develop a comprehensive position-by-position workforce plan. Salary and fringe have both increased in the 2026 CSL over what was included in the 25 adopted budget. Growth in salaries is outpacing growth in fringe, which is primarily driven by collective bargaining agreements being settled at salary increases higher than what was historically negotiated. These agreements impact both steps as well as cost of living adjustments for positions represented by those units. The budget division plans for annual increases in personnel costs based on growth assumptions that we revisit annually in collaboration with HR. The 2026 CSL general fund budget for salaries and wages and fringe currently sits at about $4 million above what had been planned. This is primarily attributed to administrative ads, reclassifications, job maintenance studies, and labor agreements settling variance to plan. We continue to work with the Labor Relations Division of HR to ensure we are in alignment on cost projections for unsettled contracts. One final slide on personnel. So if we look at FTE growth dating back to 2023, we do see steep inclines in 24, more modest in 25, and going into 26, there's a plan for about just under 16 FTEs to be added. Those FTEs are primarily within the fire department with a federal grant expiring in mid-2026. This only captures positions added as of March. New positions do continue to be added time to time via council action, and those will not be shown in this personnel budget, but get picked up in the 27 budget calculations. So I'm now going to turn to that second input, which is internal service charges. This category of expenditures includes charges for fleet, IT, rent on lease spaces, workers' compensation and liability, and general fund overhead. In January of each year, we ask the departments who provide these services to generate an expense budget request that maintains current service levels within demand. Budget staff then review those proposals and present recommendations to the CFO, budget director, and controller, and a final determination is made about what level to fund in the following year. We followed the same process this year as in prior years, and all told, these make up 17% of general fund expenditures. On this slide is the output of that submittal and analysis within the general fund. Cost distributions are determined using various methodologies, such as customer department FTE counts, historical spending, department-specific projects and needs, and for workers' comp and liability, a report from our actuarial consultant, Pinnacle. Notably, many of these charges are demand-driven, so there's little surprise to the receiving department of these costs. I also want to note that changes in personnel costs can have a cumulative effect on growth in these charges, because the personnel costs of the internal service department are a significant driver of the costs that they then allocate out. Therefore, position adds not only increase a department's personnel budget lines, they also increase the internal service charges, as there's an assumption that that department will consume greater service levels. The accountants for these funds have finalized the charges for 2026, and we're seeing that internal service charges to the general fund are increasing by about $6.4 million between 2025 adopted budget and 2026 CSL. General fund departments are provided the budget to pay for these charges each year, so any changes, either up or down, have no operational impacts on the programs they provide. Now we'll transition to hear about how we're paying for the expenses by looking at our completed revenue forecast. Most of the non-levy revenues are final at this point, although certain intergovernmental and other revenues may still see some adjustment as we progress towards the recommended budget release. Our revenue forecasts are the result of close collaboration between our office and subject matter experts from across the city. I want to take a moment to thank the many individuals who contributed to shaping this outlook, especially our dedicated budget staff. Their hard work has been instrumental in helping us limit unnecessary increases to the tax levy. Before zeroing in on the general fund, a very quick look at enterprise-wide revenues into all funds. This view here includes the general fund, special revenue funds, debt funds, and others. I will note that enterprise funds, grants, downtown assets, and capital are still under development, which is just a reality of data availability and planned budget milestones. These will be finalized through the month of July and definitely by August. This visual is showing net local options sales tax revenues, which are the groupings of local sales taxes that fund our assets, operations, debt service for those assets, and economic development related activities. In terms of gross revenues, after nearly hitting pre-pandemic levels in 2022, we well surpassed them in 23. That resulted in a 10% year-over-year growth, which has since cooled down to 7%. More specifically, we saw roughly $92 million in gross revenues in 2018 and 2019. We surpassed that in 2023 with $100 million and are planning for $115.3 million in 2026. Estimates are reached by reviewing trends in historical actuals, recovery, and taking into consideration other forecasts, like the Minnesota Management and Budget's annual economic outlook, which is published in February. To dive a bit deeper on these revenues, 2025 Q1 gross revenues are roughly $2.5 million higher than the 2024 Q1 revenues.
Excuse me, I wondered if I could,
Yeah.
did you say 115 million was the projected amount?
That is correct, for 2026.
I'm seeing,
These are, I might have misspoke, these are net receipts. So 115 is the gross.
thank you
And I'll
very
get in a
much.
second into
Thank you.
withholdings. Yep, apologies. So 2025 Q1 gross revenue is about $2.5 million higher than the same time period last year. We did see a lag in Q1 of 24, however, that the year did finish strong, so it was seen as an outlier. One final note about withholdings, which is the variance between the gross and the net. So there are essentially two buckets of withholdings within these tax revenues. The first one is the Minnesota DOR admin fee, which historically has been about 1.35%. That was dropped down to 0.9% last year, and we anticipate that to continue going forward. Additionally, there are state-bonded debt service withholdings that are mandated and fixed, and there are variable withholdings for the Minneapolis Sports Facility Authority that is dependent on the amount of revenues we receive. Though we're still finalizing the downtown assets plan, we can incorporate the final 2024 actuals and ending fund balance, the updated lost revenue forecast, and the updated general fund transfer to determine how these elements are impacting the outlook. So this chart will show you the 6-year outlook from 2025, which projected the fund balance dropping from 83 million down to 57 million in 2030. That recalculated outlook today shows 85 million in 2026 down to 29 million in 2031. There are a few items that are impacting this. First, the steep decline in 2030 that you see is attributed to a balloon debt payment for the Target Center of $16 million that could be negotiated in forthcoming years to smooth out. Additionally, this assumes no debt issuance for the convention center in the 5-year plan, which would be unlikely but is still being determined through the development of the downtown assets finance plan. Finally, revenues are performing strong, and they're attributing to that increase expectation even beginning in 26 and 2027. A few items that could change this picture. We continue to monitor gross and net receipts alongside our development finance team and the convention center to ensure we're forecasting estimates grounded in the best available data. Additionally, as the tourism improvement district moves forward, it is quite likely that there will be a correlated impact to these revenues. Finally, on the expense side, any increased economic development funding in the general fund supported by these revenues has a very real and cumulative impact to the health of this fund. While it's certainly permissible given state statutes, there will come a time when it's no longer sustainable for these assets. Now we'll focus exclusively on the general fund, but excluding interfund transfers and use of fund balance to really focus on the outputs of our forecasting process. The outlook for 2026 remains slightly positive. Specifically, we're forecasting 7% year-over-year growth from 615 to 659 million. You'll notice this differs from the 3.64% that we saw earlier in the presentation, and that's because this is focusing on a subset of total revenues, primarily not using the use of fund balance, which earlier was presented. So this year we saw a few notable increases and decreases. First, I'll go over the increases. The first of those comes from the charges for services and sales, which are up by 1.8 million. This growth is largely driven by revenue from the park board for their use of city services. In the past, we've kept this charge artificially low, which meant the tax levy was subsidizing those services. This year, we partnered with the Comptroller's Office to better align or right-size those charges and clarify which services are included, and those conversations continue. It's important to note that initially this number was 2.7, and that was dropped down to 1.8, and any future adjustments will have a direct impact on the tax levy. Moving into fines and forfeits, this is attributable to a Public Works and Reg Services-led pilot around speeding citation revenue, which is set to go live August 1st of this year. There are restrictions around eligible uses for that revenue. It's primarily within traffic safety operations and traffic calming. On the flip side, with notable decreasing revenues, franchise fees collections were under by about $3 million in 2024. So to dampen our expectations going forward, the 26 outlook has reduced to align with our 2025 forecast. Then in licenses and permits, this is primarily the CPED code construction services around development activity. These were reduced by about $2.5 million from plan. And these are driven, as I mentioned, through development activity. And so we monitor the Planning Commission approvals as they serve as a lead indicator for these revenues. In 2023, we had the lowest projects dating back to 2012 at about 29 projects. Unfortunate to say, in 2024, that was dropped to 12 projects in total. So we continue to monitor this activity and we'll adjust that revenue stream as needed. Diving into the forecasted figures a bit more, this is the taxes category within the general fund. And property taxes account for roughly 88% of this category and 53% of general fund revenues. This equates to currently $376 million planned for 26. The property tax revenue forecast shown here currently follows the 5-year financial direction that was documented in the 2025 adopted budget. As Director DeSenza mentioned, this was 6.8% in 2025, 10.8% in 26. It's important to note that under the CSL that we are seeing today, we would need to increase that to 11.2% to balance, as was shown earlier. Again, these figures account for no new unplanned spending, as well as alternate revenue sources and or prioritization of CSL programs. The final revenue category we'll discuss today are intergovernmental revenues, which are the second largest revenue source in the general fund. Additionally, local government aid accounts for roughly 10% of general fund revenue and 84% of this category. After some slight concern at the Capitol earlier this year with reductions to local government aid, we're pleased to see that is being forecasted to held flat. So we are estimating to get about $72 million in local government aid. Also important to note that this is spread out amongst the city, the park board, and the municipal building commission. This is a revenue that gets certified in July or August, so sometimes we do see modifications as we get closer to that certification, but we are in consultation with our IGR team to confirm that we're forecasting these appropriately. Okay, so to bring all this together, today we started by looking at expense category trends, including personnel and internal service funds. We also touched on the base budget and how we keep costs flat at the department level. From there, we walked through our major revenue sources, and now looking at both revenues and expenditures, it's clear that we're not currently in balance, even with the planned 10.8% levy increase. I will mention, as was mentioned before, it's a lot more modest than we saw last year. This view includes all planned interfund transfers and the use of cash for one-time expenditures, as was adopted in the current year's financial plan. What you're seeing here reflects the balanced 2025 budgets adopted in last December, and the projected plan for 26 through 2031. As a reminder, the general fund is the most flexible part of the city's budget, where policymakers spend much of their time making key decisions. While recent years benefited from significant federal and state dollars, we now face continued uncertainty around inflation, tariffs, and the tapering of federal funding. This environment calls for a more cautious and strategic approach to financial planning. Over the next several months, our office will work closely with the mayor and with Budget Committee leadership in the fall to develop a balanced, recommended, and ultimately final budget. Unlike previous years, we're not starting from the current service level as the baseline. Instead, we're using this as a reference point while we focus on prioritizing core services. This year, there was no open call for new spending proposals to departments. The city is committed to limiting financial risk and ensuring that Minneapolis remains an affordable place to live. Our focus now will be on pulling every available lever to maximize ongoing revenues and using those estimates to align spending with city priorities. In contrast to prior years since the pandemic, this year our conversation will center on how to close the gap, reducing the property tax increase, and achieving a balanced budget by August. With that, I'll wrap up with a brief look at the timeline ahead as we move towards adoption in December. So here's what we have in the pipeline for the budget process over the next several months. Today, we've presented the current service level as our early estimate of revenues and expenditures. In June and July, department budget submissions are currently being reviewed and presented to the mayor for decision-making. In August, the mayor's recommended budget will be formally released. In September, our office will return to provide an overview of the recommended budget, and the Budget Committee will begin hearing department presentations through October and November. This is also when public hearings on the budget generally take place. Finally, in December, the process concludes with budget markup and formal adoption. We look forward to working with you all as we move through this process and work towards a balanced 26 budget. And with that, we will stand for questions.
Captioners can continue past 6. Commissioner Benny?
I do have a quick question, and actually that was very helpful, that presentation. Could you go back in the slides a little bit? I don't know, they went off the screen. But I have to always ask the park board questions. It was the fees for charges for services, and the park board one is going up, and I know that isn't a discussion between the staff. But so did you said that they historically have been kept historically low, and the city's taking a bigger look at maybe the ways in which the park board should be paying a different share of support to the city. Is that?
Yeah, through the President, Commissioner Bene. From my understanding, I've been with the department about 2 years, but from my understanding, looking at that model, I think historically there's been some assumptions made of which other funds in the city, other agencies, what services they're using. Mm-hmm. And with the new leadership in the Controller's Office, we've worked to itemize those and have ongoing conversations of which services there's agreement of that are being utilized.
Yeah, okay. And I think that there's maybe, I've had a little insight into that. The one thing you said something about also looking at then the levy not carrying that. If the park board's portion's being artificially sort of subsidized, it has a negative effect on the levy. Is that what you said, or?
Yeah, through the President, Commissioner Bene. Yes, that's correct. So if those costs are not recouped through the various entities that we charge out for the overhead costs, then those are covered by the tax levy.
Okay, so the numbers I've seen right now, it's going up almost 100%. It's close. It's in the 90s, I believe. But I would just say this. The park board only has the mechanism of paying those fees, really, with the levy as well. So it still would be the same impact. Wherever those fees are paid, if it's money given to the park board to pay the fee, or the park board or the city pays the fee, it's just kind of a wash. But, okay, thank you.
Commissioner Payne.
Thank you, President Brandt. Building on the internal service charges, I'd actually really be interested in seeing the methodology, and specifically I'm interested in understanding what the cost drivers are. I'm assuming it's activity-based accounting. And, ideally I'd love to see, we have the 5-year projection here of the total cost pools for each of the internal service charges. I'd love to see how those cost drivers map out by department. That might be a bigger ask, but just at least seeing the methodology and the cost drivers would be really helpful for me.
Yeah, absolutely.
Commissioner Chutai.
Thank you, Mr. President. Similar to Commissioner Bene, I always think it's a little bit silly when we talk about the internal service charges, just being recouping costs and preventing them from becoming a property tax burden, but we charge them to departments who pay them out of money that is supported by the levy, and that's as true for any department as it is for the park board. So I mean, it all balances out in the end, but let's not, I just think it's going a little far to say that this money isn't property tax supported in one way or another. I would be curious about just getting a deeper understanding, and I think I would imagine you're going to come and present the current service level presentation to the budget committee at a future date, as you do every year. And so, I'm happy to wait to get a response to this until you come to us, so not urgent. But I'd love to see some detailing about, the increases to the IT budget from 2023 to now. I would imagine the ERP program is a driving factor of that, but would just love to see some further details about where this is going. I'd love to understand why we saw a 30% increase to the property services allocation from 2024 to 2026 over 2 years. That seems very significant to me. I'd love to understand how liability and self-insurance has changed pre-2020 to now. And would be really curious to understand where there may be vacancies among in staff in each of these internal service funds. So perhaps that can be a part of helping drive reductions to the internal service budget, and how significant it is, and how much it's grown over the years. And then finally, I'd say I would love to understand better. There's one more thing on internal service charges, and I honestly can't remember right now. Going back to a previous slide, I think it was slide 13, where you here, I have it pulled up in front of me. It was when you're talking about the methodology of general fund CSL expense budget 2026. CSL includes these changes, so it's, I believe, the one right after this. Yep. Can you help me understand discretionary base held flat? Like, what does that mean?
Yes, absolutely. Through the President, Commissioner Chuktai. So the discretionary base, in all intents and purposes, is any non-personnel expending within those departments. So we do not grow those. In some cities, you'll inflate those year over year. We do not grow those because per financial policies, the goal is for the mayor and the council to review those against all other requests. So those are held flat for general fund departments each year in the current service level budget. We only redo the personnel recalculation and internal service charges.
So we should anticipate that when departments come to present their budgets, they'll detail their discretionary based budgets and explain those so that we can meet the obligation of financial policies and actually review their discretionary based budgets.
Through the President, Commissioner, certainly whenever there's changes to the overall dollar amount, that's when we see those budget proposals, or formerly known as change items. That is how we comply with that policy, so that there's a full discussion around those increases before they're adopted.
Sounds good. That sounds great. Thank you.
Other questions? Okay, I had a few. I was struck by the new leases in property services being a cost driver. Is that because we are needing more space, so we're adding additional square footage to house, say, additional personnel, or is it predominantly rising per square foot charges?
Yeah, President Brandt. So there's a number of new leases that have come on for fire, Century Plaza, and that is driving those costs.
So basically different spaces that are coming on.
That is correct.
Okay.
Yep. Mm-hmm.
And are the square footage charges the city pays for rented space generally benefiting from the down real estate market downtown?
President Brandt, I do not have the answer to that, but we could find that out.
Okay.
And work with our property services department.
All right. And talking about real estate costs brings up, in my mind, from the click days, the plan when the new building was completed, kitty corner from City Hall, to dispose of this building and the City of Lakes building. Last time I think I inquired about this, I was told it's not a good time to sell, but I'm wondering if there's any progress being made in that regard, particularly now that we can see moving back into the third floor on the horizon.
President Brandt, I know Finance is really excited. I think we're moving at the end of July back to City Hall. My understanding is that this chamber will be maintained, and so that will require this building not being sold for, I'm not sure what the timing is on that. And then City of Lakes, once that's fully empty, I think that will be revisited as well.
Okay, not to not to put this on your shoulders, but it feels a little bit like a bait and switch when part of the financing plan for the building at the opposite end of City Hall from where we are now was sold on getting income from the disposal of those two buildings. There's no space in, and again, this is probably a council space allocation decision that's not within my hands, but you would think that in a building that big there would be meeting spaces that could serve the purposes that, for example, this meeting space would use, so that we could realize some of the cash that was part of the financing plan for that building. And that's maybe a comment. I don't know if you...
I think the only thing I'll say, President Brandt, is that it certainly is true that the downtown market is not what it was prior to COVID. And so certainly if we're going to dispose of properties, we'd want to make sure we're getting the most value. But, I defer maybe to our commissioners or perhaps the city clerk on the use of this particular chamber.
Okay. And then, all right, Commissioner Jutek, please.
Yeah, thank you, Mr. President. Just wanted to address your question about these chambers. So the City Hall across the street, where we historically have met, you are correct. It's a large building. There's a lot of space in it. It is also a building that we share with Hennepin County, owned by the Municipal Building Commission, and there are significant portions of that building that are occupied by either the Hennepin County Sheriff's Office or other functions, the jail, the juvenile detention facility, etc. A part of the consideration, and I can appreciate that this is in part maybe a council decision, but it is one that is largely driven by both the city clerk, who you're correct does report to the council, and property services, who reports to the mayor ultimately. A large part of the reason is because certain types of meetings, including the Board of Estimate and Taxation and all Tier 1 boards and commissions, require those meetings to be broadcast live, include closed captioning. One of the significant challenges that we run into in carrying out our full-time jobs, which is serving as members of the council, and doing our work at the committee level, is time constraints that come from when committee meetings need to end, so that evening meetings, such as the BET, but not the BET alone, the Planning Commission, et cetera, can continue their meetings. That also has a pretty significant burden on clerks and attorneys that you see sitting over here that are nonpartisan professional staff who have to turn around a room in a matter of minutes and don't get a break because they have to keep the record of our meetings. And so, it creates a pretty significant staffing challenge within the clerk's office. It creates a pretty significant problem with captioning services, but more than anything else, when we can't complete our business because we need to vacate the chambers, right? When you walked in today, you saw the Commissioner Payne's laptop and materials sitting here. It's because he had committee right before this, and it went until we started here. So, that's what was being weighed, from the way I understand it, by our clerk and by the property services director, and I don't think it's the incorrect conclusion, to maintain the space so that we can continue for all of us to do the business that we were elected to or appointed to complete.
Okay, I hope I was clear enough. I wasn't suggesting that the functions that are currently here be handled in City Hall, which, as you say, is a shared building, but in the further building, the Public Service Building, which I hope gets a new name so we can eliminate some of the confusion in the future. But thank you for that. Appreciate that. I would like to do a time check right now. First of all, do we have an extension from our captioners?
Mr. President, we do not yet, but she is working on seeing if it's possible.
All right. I see two items on the agenda today that are sort of must-do things. The item that Commissioner Priest Stenson has brought up to substitute the clerk in the information request process, and then also the authorization of the staff to the authorization of the staff training, a budget amendment. I don't know that I would be, in an ideal world, we'd tackle and work our way through at least some parts of the work plan discussion. But does anybody have a thought on what's the pleasure of the group? Commissioner Priest Stenson.
If we're not able to get to actually approving the work plan today, I do think that there is some discussion to level set some things in order to keep things going smooth for our staffer, Christina Keiderling, as well as for ourselves. Some things that came up during my leading the onboarding process with her that I just don't see would be wise for us to wait until the June 25th meeting. So at least a basic discussion to make sure that we're all on the same page about the difference between somebody's job description and the work plan and where we're at and what we're able to ask of our staffer. I would at least like to be able to talk about that even if we can't full on get to approving the work plan.
All right.
Mr. President, we just got a response from the captioner, and they are able to stay until 6:30.
Wonderful. That helps. Let's proceed. I have a few more questions. One is about and I know I tend to extend meetings with them, the lost revenues. That's a healthy picture. There's a rebound, as was predicted after the pandemic waned. Can some of that be transferred over to help subsidize the general fund to a greater degree? I know that's not holding current conditions level, which is the purpose of this document. And then you mentioned in the next page, of course, that the fund balance for the Downtown Asset Fund is projected to decline, although there's a caveat that the payment could be, the balloon payment could be re-amortized. But if you could address the question of a greater degree of subsidization from the lost revenues.
Yes, absolutely, President Brandt. So within I think I'll start with the categories of lost revenues. So the entertainment tax is the most general purpose revenue of those revenues. So currently that, I mentioned the general fund transfer. I think we're all relatively familiar with it. The full amount of entertainment taxes are currently booked to go over to the general fund each year. In addition to that, within the stipulations and state statutes, any economic development related activity can be funded by the remaining of those taxes. It's further down on the itemization of uses, first being operations and debt service within the assets, but economic development programs is also an opportunity. So we revisit the amount of programs in the general fund annually that would be applicable to that. And so that is a way that we can get additional revenues into the general fund. Beyond that, it does need to meet that threshold.
And I'm sorry, I may not have been listening carefully enough and thinking about my next question, but is there still economic activity not funded from these sources that could potentially be funded if more were shifted?
Just for a clarifying question, existing programs is what you're asking?
Yes.
We will look at that. I would say we do this annually, so I think it's rare that additional programs would be identified, but that is something that we look at every year.
Okay. Thank you for that answer. I'm not trying to be a council member here in budget spending, but I just wanted to know for purposes of the levy. And is my understanding correct that the expansion of the downtown taxing district to include all of the North Loop failed this session?
Yes, that is my understanding.
Okay, I'm sorry to hear that because I thought that was low-hanging fruit. But the legislature, in its wisdom, and of course the drawdown in SALT would be affected should there be a proposal potentially affected if there were a proposal put on the table for a new basketball arena, and a request that some of the downtown entertainment and so on taxes be used for that purpose. All right. And trying to move through quickly. And I think that's it. Thank you very much for this presentation. Any further questions? Thank you. I'm going to go back and listen to this at least once more and maybe twice. All right. Thank you. The clerk will receive and file this presentation.